Most retail investors chase the best-performing fund, always hoping to pick a winner. But history shows that true wealth creators do something different. They focus on building the right structure, a disciplined, category-based portfolio designed for the long run. This is the Billionaires Club 2050 Mutual Fund Cheat Sheet. It is not a list of top stock tips or secret schemes. Instead, it's a clear, educational framework based purely on SEBI-defined mutual fund categories. We offer no investment advice, no recommendations, only structure, discipline, and intelligent allocation, so you can chart your own course with clarity and confidence. This video is strictly for investor education and awareness. It does not constitute investment advice, research advice, or a recommendation under SEBI regulations. Billionaires Club 2050 is not a SEBI-registered investment advisor. Before making investment decisions, consult a SEBI-registered professional. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Let's break down the 6-bucket mutual fund structure every disciplined investor should understand. First, large-cap funds. These are your stability anchor. SEBI defines large-cap funds as investing at least 80% in the top 100 companies. Their primary role is to provide stability, capture the overall market's returns, and reduce portfolio drawdowns versus riskier segments. They might not offer thrilling gains every year, but their steadiness is the bedrock of an efficient portfolio. Second, mid-cap funds, the growth accelerators. They invest at least 65% in companies ranked 101 to 250. Mid-caps tend to grow earnings faster and outperform in recovery cycles, though they bring more volatility. Over long periods, disciplined exposure to this space delivers a valuable growth premium. Third, small-cap funds, the compounding engine for your portfolio. By mandate, at least 65% is invested in companies beyond the top 250. Small caps symbolize entrepreneurial India and offer vast growth potential, though their short-term volatility is high. The secret here is consistent, disciplined allocation instead of emotional, knee-jerk reactions. Fourth, flexi cap funds, your tactical allocation layer. These funds can invest across market caps, giving managers flexibility to rotate between large, mid, and small caps based on market cycles. This flexibility can help manage shifts in sentiment and reduce mistakes caused by emotional investing. Fifth, multi-asset funds, the optional stability layer. These funds spread investments across at least 3 asset classes like equity, debt, and gold. Since different assets behave differently during various market cycles, this layer lowers the overall volatility and smoothens the investor experience. Sixth, debt and liquid funds, your risk control and opportunity capital. Their core job is to preserve capital, provide liquidity, and offer deployable funds during corrections. Rather than seeing them as low-return assets, view debt funds as essential volatility managers. Why does this structure matter? Because true alpha, or excess returns over basic benchmarks, often comes not from chasing trends, but through engineering. Diversification across these 6 categories, periodic rebalancing, managing volatility, and encouraging steady behavior can together create alpha. It's about structure, not speculation, and discipline over prediction. Let's now talk about the yearly bonus, or one-time lump sum, the salaried investor's dilemma. Instead of deploying bonus entirely in equity on a single day, consider this. Park your bonus in a liquid or ultra-short duration fund and gradually deploy it into equities over 6 to 12 months. This educational framework doesn't aim to time the market, but to reduce entry risk. By spreading out your investments, you avoid putting all your capital at potential market peaks and benefit from cost averaging. In bear markets, deploy the STP or systematic transfer plan. Rather than investing a lump sum into equities during market stress, park your funds in a debt fund and methodically transfer a fixed amount into equities each month. This approach helps you capture lower average NAVs, builds your portfolio steadily during market pessimism, and removes emotional hesitation, all while fostering disciplined buying in challenging times. Ultimately, alpha isn't about stumbling upon a magical fund. It's the result of structure, allocation, rebalancing, behavioral control, disciplined deployment. The Billionaires Club 2050 framework is not about predicting the next market move. It's about adopting proven habits, reducing regret, and compounding confidence in every market cycle. This content is for educational purposes only and does not constitute investment advice, recommendation, or research under SEBI regulations. Billionaires Club 2050 is not a SEBI-registered investment advisor. Always consult a SEBI-registered professional before making investment decisions. Mutual fund investments are subject to market risks, and past performance does not guarantee future returns.